the 2025 FOREX Trading Empire Mentorship Program, Lecture 34. The topic for this lecture is daily review. I'll be doing a daily review on a trade I executed on GBP USD. Starting from the daily time frame, I'll be explaining how I determine my bias on the daily time frame, down to how I got into the trade and what was the criteria before getting into the trade. On the daily time frame of GBP USD, looking at price from this daily fair value gap, I was anticipating a reversal down close candle because I'm anticipating price to respect this daily fair value gap to lead to a retracement back to this fair value gap to fill in this fair value gap, and my target should be the previous day low. So going lower, you can see the price took out the previous day high, the retracement took out the previous day low. I was anticipating a retracement lower, a reversal candle against this initial uptrend, which would be an uptrend from the 1 hour time frame or on the 4 hour time frame. But price traded to a daily fair value gap. I was anticipating a reversal down close candle. So the candle opened, took out the previous day high. Now it's still valid because this previous day high might be a liquidity. Price did not actually did a full reversal from this candle, trading to the daily fair value gap. So trading back to the daily high, running the daily high before a retracement, before going for the daily low, is still aligned with the bias. So I was anticipating a down close candle. You can see how price took out the daily high and took out the daily low. Now I posted about this trade in the Telegram group as a case study. So for those who are currently on the current video, you understand that I posted the same chart explaining on how I executed the trades. On the 1 hour time frame, I've mentioned this a few times throughout the videos. I will tell you guys that whenever you're using the daily buys, the 1 hour time frame should be your bellwether chart where you are seeking out to mark out your buy sell liquidity, your sell sell liquidity, your opening price, and to understand the current trend of the 1 hour time frame to give you a clear perspective of that bias if it's fully aligned with your daily perspective. So on the 1 hour time frame, price open, traded higher, took out the previous day high, internal shift in structure, traded lower, took out the previous day low. Now, your trend is to look for an entry after a run on the previous day high, lower prices. Clearly, you can see that before the close of this previous candle, price did not shift structure to a downtrend. So that's why it's always important to take your perspective from the 1 hour time frame if it's aligned with your daily time frame. Price closed did not need a 1 hour shift of structure. It's still an uptrend. Price traded higher, took out the previous day high, did a shift in structure. So going further, you can still anticipate more lower prices because the 1 hour trend is now in a downtrend and the daily candle is indicating a reversal. Or we might see a trend trading lower going further. But in this example, took out the buy side liquidity, retraced, took out the previous day low below the opening price. Clearly, you can see a classic power of three accumulation, trade above this high, manipulated, then price distributed to the previous day low. On the 15 minutes, you can see the internal shift in structure. Price traded lower, took out the swing low. Here's the other block, retracement. Price traded to the 15-minute fair value gap, but traded through the 15-minute fair value gap. Price was reaching out to this 15-minute order block and up close candle. And before looking for a trade, you need to see a 15-minute shift in structure. Whenever price takes out a previous day high and you're anticipating a reversal, now it depends on your own trade plan. There are some trade plan that you can easily look for a 5 minute shift in structure and manage that trade correctly. You'll still be involved in the same bias. While there's some scenarios where the 15-minute structure will give you the best entry. That's why it's good to tackle through both time frames. But in this example, took out the swing low retracement or the block, respected the other block, shift in structure, retracement back to the 15-minute fair value gap, respected the 15-minute fair value gap, traded lower to our target. So you can see at this point, I think it's now easy for you to identify this trade setup where if it will repeat itself on previous charts or next week, you can easily identify that price is leading to a downtrend. With seeing this shift in market structure, you'll be anticipating price, and when price did the shift in structure, you can easily execute from this hot block. On the 5 minute time frame, you can easily identify the 3 a.m. to the 4 a.m. setup. So you can see the 3 a.m. to the 4 a.m. fair value gap. Price from the fair value gap, you can see how price respected the fair value gap. Price did the retracement back to the fair value gap. Remember, the trade is still valid because your stop will be at this high, and price did not trade to the high. Stayed below the high, traded lower, took out the previous day low. So on the 5 minutes, you can still see the 5 minute structure, but that's why it's always good to look at multiple time frame, like for entry. It's good to look at the 15 minutes and the 5 minutes. You learn how to combine both time frame to look for the best entry. Which will give you the best risk to reward should be the 5 minutes. The 5 minutes will always give you the higher risk to reward, but there's still a possibility of you being stopped out even before the initial move. And there's still a probability of you taking multiple losses before actually catching the main trade. But in this example, traded back, here's the 15 minutes on the block, stopped at the 15 minutes on the block, traded lower. Your target should be the previous day low. I think this point, talking about this trade plan is now being reaxed. So make sure you go through the chart, go through this previous week chart and look for example that fits this example. When you have a daily bias, use your 1 hour to see if the 1 hour trend is fully aligned with the daily bias. Then you use your 15 minutes for entry and your 5 minutes. You can go lower to 1 minute, but you need to see some sort of confirmation before using that 1 minute for any entry. Now, there are many ways to do this. When it comes to the entry pattern, there are many entry logic for you to use to take an advantage of this setup. The point is having a narrative and a bias. So when you have a narrative and a bias, you can easily align it with any entry model. So that is it for this lecture. See you guys in the next lecture.